Good morning everyone, this is Charalambos Pissouros, Senior Analyst at IronFX, bringing you the morning comment for the 22nd of September. Fed stands pat, signals one hike still likely. The Fed left interest rates unchanged but signaled that the near-term risks appear roughly balanced and that the case for a hike before the year end has strengthened. Three officials even voted in favor of a hike at this meeting, and this agreement level last seen in December 2014. At her press conference following the meeting, Fed Chair Yellen said that the decision to remain on hold does not reflect a lack of confidence in the US economy, but the board is waiting for further evidence of continued progress towards its objectives. The updated dot plot showed that the path of interest rates has been lowered, with officials expecting one hike this year versus two in June and two hikes next year, down from their June median projection of three. They kept their median estimates for 2018 at 3 and expect 3 hikes in 2019 as well. Officials also pared down their estimates for long-run economic growth and now expect it to settle at 1.8% per year, down from 2% in June. Investors did not reprice significantly their bets on the timing of the next rate hike, with Fed's funds futures suggesting a just above 50% chance for a move at December's policy meeting. The main message we took was that the Fed remains patient and waits for further improvements in the jobs market, and that the pace of hikes is lowered further. Going forward, the focus remains on the upcoming data and whether they will be strong enough to give policymakers the confidence needed to act this year. We believe, however, that the risks surrounding the near-term response of the dollar are likely asymmetrical, with any disappointment in upcoming US data likely to generate a bigger market reaction than in the case of positive figures. As such, the dollar remains data-driven, and significant positive data are now required for the currency to regain momentum. Overnight, the Reserve Bank of New Zealand kept rates unchanged as expected, but signaled that it intends to cut rates again to ensure that inflation settles near the middle of the bank's target band. Even though recent data showed an improving economy with the labour market tightening in the second quarter, strong retail sales and accelerating GDP growth, inflation has been below the bottom of the RBNZ's target range for 7 straight quarters. We view November as the ideal period for policymakers to cut rates again, especially given that the bank's updated 2-year inflation expectations come out before that policy gathering. Considering that a tumble in this indicator was a catalyst for the surprise rate cut in March, we believe that another soft reading may be the trigger the bank needs to ease again. The kiwi could come under selling interest as expectations build up for a near-term rate cut. As for today, during the European Day, another central bank meets to set policy, the Norges Bank. This bank is expected to remain on hold as well, a view that we agree with, given that downside risks for Norway's economy appear to be diminishing somewhat. Even though the Norges Bank penciled in another rate cut before year-end at its June meeting, we doubt that officials will deliver one now. Inflation was well above the bank's target in August, the unemployment rate remains at very low levels, while GDP growth for mainland Norway came in slightly higher than expected in the second quarter. In addition, the bank's regional network survey, which was published the previous week, showed that the outlook for growth in the private sector is improving, suggesting that there is no immediate need for policymakers to act. Even though all this leads us to conclude that no action is likely right now, we still expect the bank to keep the door open for further easing this year, mainly because not enough progress has been made in the economy to materially change the policy outlook. As for the indicators, we get the US initial jobless claims for the week that ended on the 16th of September, and expectations are for a minor increase to 262K from 260K previously. This will leave the 4-week moving average unchanged at 261K. Existing home sales for August are also coming out, and expectations are for an increase following July's slide. We have two speakers on Thursday's agenda: ECB President Mario Draghi and Bank of England Monetary Policy Committee member Christine Forbes. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.